Welcome to breaking news to trading moves. If we look back at May 2010, the stock market went into this complete catastrophic freefall.
Right. Trillions of dollars just vanished in a matter of minutes.
Exactly. But the most terrifying part of that whole flash crash wasn't just the speed of the drop itself. It was that the very safety tools traders used to protect their money were the exact things accelerating the destruction.
Yeah, it really is a paradox in market mechanics.
It is. You expect a safety mechanism, like a physical circuit breaker in your house, to just cleanly halt momentum during an emergency. But during that crash, resting stop-loss orders triggered, converted into market sell orders, and blindly dumped assets into an empty market.
Locking in devastating losses.
Right.
The exact instrument built to shield a trader's capital turned into the precise mechanism that orchestrated their financial ruin.
Absolutely. And that historical event connects the dots to our core debate today. We have to ask, are physical, hard-coded stop-loss orders a mandatory risk management tool that protects you from unrecoverable drawdowns? Or do they act as a structural vulnerability, exposing you to targeted institutional exploitation and artificial volatility?
All right, and I am definitely taking the opposing view here. I argue that hard stop orders actually turn your risk management into visible liquidity for institutions. Keeping your intentions hidden from the market, relying on uncompromising position sizing, and using alternative hedges offers superior mathematical protection.
And my position is that physical stop-loss orders provide a absolutely necessary, emotionless mechanical barrier against those unrecoverable losses.
Okay, well, let's lay out the mechanics of that.
Sure. So let's start with the reality of the trading environment. We aren't operating in a sterile, predictable laboratory, right? Markets are inherently chaotic.
Obviously. Geopolitics alone.
Yes, geopolitical headlines hit the wire without warning, sudden overnight price gaps happen, or, local technology outages at your specific brokerage can disconnect you at any moment.
Right. You lose your connection and you're blind.
Exactly. And without a resting order residing directly on the exchange's order book, you rely entirely on human reaction time and manual execution. And the behavioral data from the material shows us quite clearly that manual execution consistently fails under extreme stress.
You mean because of panic?
Yeah. The human brain naturally resorts to bargaining. It causes traders to hold deteriorating assets and lets small, planned exits turn into total capital destruction.
I hear that, but I come at it from a completely different angle. The moment you place that physical order on the books, you are broadcasting your exact exit parameters to the broader market.
Broadcasting? It's just an order on a server.
But you are altering the market structure by doing that. You turn your personal protection into combustible fuel for other participants. Large players, whales, market makers, algorithmic trading desks, they can actually see these clusters of stop-loss orders.
Right, because they have the depth of data.
Exactly. And those orders are predictably placed right near obvious support levels around numbers. So they intentionally push prices to trigger those exact clusters, absorbing all that forced selling at a discount before the price inevitably rebounds.
Hold on, I need to push back on the framing there. When you say institutions are pushing prices to hit stops, are you saying market makers are deliberately crashing the price by 10 cents just to trigger my specific retail stop loss?
Not yours specifically, no.
Because isn't that assuming a retail trader's individual order is far more central to the market than it actually is?
Well, they aren't hunting your specific 50 shares. They are hunting the aggregate cluster. We really have to look closely at the mechanics of liquidity hunting because it's an intentional structural maneuver driven by institutional necessity.
Okay, walk me through that necessity.
Imagine an institution needs to move a massive block of shares, say 100,000 shares of a specific equity. They can't just click buy at the current market price.
Right, because there isn't enough volume offered at that single price point.
Exactly. The order book might only have a few thousand shares offered at the current asking price. If they execute a standard market order for their entire massive position, they'll consume all the available sell orders at the current price, then they have to buy the next price up and the next price up.
They just chew right through the order book.
Yeah, they suffer severe slippage, totally ruining their own entry price. So to enter or exit these massive positions efficiently, they absolutely require localized liquidity.
And they find that liquidity exactly where retail traders park their stop losses.
Precisely. Let's say a stock is trading at $101. A well-defined technical support level sits exactly at $100.
A very obvious psychological level.
Yes. And the institution knows a dense cluster of retail sell stops is parked right at $99.90. The institution applies mild selling pressure to gradually push the price down through that support.
And once it breaks,
the moment the price breaches $99.90, thousands of retail stop losses activate simultaneously. Those stops instantly convert into market sell orders, creating a massive surge of forced selling.
wow, so they basically create their own liquidity event?
Exactly. The institution already has their giant buy limit orders waiting right there. They absorb all that panic selling, accumulate their massive position cheaply without slippage, and the price snaps back upward. The retail trader is left empty-handed, having sold at the exact bottom.
Okay, I see why you think the tool is the problem. But let me offer a different perspective. I challenge the idea that the stop loss itself is inherently flawed.
How is it not? You just agreed they get hunted.
Because the vulnerability you are describing comes strictly from lazy placement. I mean, placing a stop exactly at a round number, or right below a glaringly obvious support line on a chart, is like putting your house key under the welcome mat.
A welcome mat that everyone can see.
Exactly. You are making it entirely too easy for a predator.
But how do you mathematically avoid a hunt when the market makers have the technology to see the entire depth of the order book? If the order is there, it's a target.
You don't use static lines on a chart. You use volatility adaptive placement, specifically average true range or ATR-based stops.
Okay, break down exactly how that shields the order.
So the average true range measures the historical movement of the asset over a specific time frame, usually 14 days. It calculates the high, the low, and the close to tell you exactly how much the asset normally vibrates on a daily basis.
Right, establishing its normal rhythm.
Right, so if a stock averages a $2 daily range, placing your stop 50 cents below your entry is practically begging to be triggered by normal daily noise.
Yeah, a market maker doesn't even have to hunt you at that point.
No, they don't. The asset's natural breathing will just shake you out. But by mathematically measuring the historical volatility and placing your stop 1.5 to 2 times the ATR away from your entry, you stay completely outside the asset's normal variance.
So you are intentionally placing it outside the operational noise.
Exactly. You avoid the obvious hunting zones. You avoid the predictable round numbers and the immediate swing lows. At that distance, if your stop gets hit, the stock isn't just vibrating.
The core thesis of your trade has actually broken down.
Precisely. You maintain a hard-coded mechanical barrier against a true breakdown. But you remove the key from under the welcome mat.
Okay, that is a compelling argument on an individual level. Using ATR absolutely keeps your specific order out of the immediate danger zone.
Thank you.
But we can't just analyze this trade by trade. Let's zoom out and look at the macro ecosystem. Even if you calibrate your stop perfectly with ATR, the aggregate presence of these automated triggers damages the entire market environment.
Damages the environment? How?
We have agent-based market simulations, utilizing historical limit order book data that prove this. Introducing stop-loss orders into a market ecosystem actually increases overall mean volatility by 27%.
Wait, let's pause right there. Are you telling me that the exact mathematical tool designed to prevent a market crash is proven to make the crash 27% worse?
Yes, just by existing in the system. And it's driven by the asymmetry of market shocks. The simulation shows that a downward shock in a market populated with stop losses caused a price deviation of $3,000.
Okay, and an upward shock?
An identical upward shock only caused a $1,000 deviation.
That asymmetry exists because markets possess an inherent long bias, right? Like everyone is buying hoping the asset goes up?
Exactly. The vast majority of participants are long. That means they place sell stops below the current price to protect their downside. There are far fewer buy stops placed above the market by short sellers protecting against upside risk.
So there is a heavy concentration on the downside.
Right. So let's look at the mechanics. Think of the limit order book as an empty staircase. Bids, people willing to buy, are standing on the steps. When a downward shock hits, it encounters a dense minefield of sell stops.
And those stops trigger and instantly convert into market sell orders.
Yes. A market order drops a boulder down the staircase. It must find a buyer. It crashes down, consuming the buyers standing on the first step. Then it hits the next step and the next. This aggressive selling consumes all the remaining buy liquidity, pushing the price lower, which then triggers the next layer of stops.
Creating a self-reinforcing price cascade.
It's a total avalanche. The stops act as combustible fuel. If no buyers are standing on the lower steps of the staircase, that boulder crashes all the way to the bottom.
Which is exactly what the BlackRock analysis highlighted during the 2010 flash crash.
Precisely. Anxiety over trade cancellations caused liquidity providers, the people standing on the stairs, to pull back.
So the steps were empty.
The market fragmented, and those triggered retail stops just chewed through an empty order book, resulting in executions at pennies on the dollar.
Okay, I acknowledge the simulation data, and that staircase metaphor makes the mechanics incredibly clear. The math absolutely holds up in a vacuum. But we have to operate in reality, and I must press you on your proposed alternative. Let's examine what actually happens during an illiquid gap or a real market emergency. Say an economic release causes the order book to completely empty out.
Sure. Volatility spikes.
Or even more realistically, say an exchange triggers velocity logic.
You mean when the matching engine pulls the emergency brake?
Right. The exchange software detects that the price has dropped too many ticks within a tiny fraction of a second. It completely halts trading to let the market digest the shock. If you're sitting there without a physical stop loss, relying purely on your intention to sell if things go wrong, you are entirely trapped by that halt.
You are paused, yes.
So how does relying on a mental stop save you when the market reopens dollars away from your intended exit?
Well, your manual execution might be filled at a poor price, but with a physical stop, you're mathematically guaranteeing your own execution during the precise moment of lowest liquidity.
But without the physical stop, you have zero structural priority in the queue when the market reopens. You're scrambling to manually enter an order while the price is gapping down.
I just don't buy that the physical stop is your only defense in a gap scenario. You're trying to solve a structural problem with an order type that actively betrays you. The superior structural alternative is uncompromising position sizing combined with options hedging.
Okay, walk me through how sizing replaces a stop loss when a stock drops 50% overnight.
It's about risk allocation at the portfolio level. If a trader rigorously sizes their individual position so that a total failure of the asset only risks 1% of their total portfolio capital, the threat of a gap or a cascade is completely neutralized.
Neutralized how?
Because you don't need a stop loss to save your account if the position size is too mathematically small to ruin it.
So you're neutralizing the risk because the total possible mathematical loss is capped by the sheer size of the allocation.
Exactly. You survive the gap because you didn't bet the house. But if you want to trade larger sizes, you use options. Options provide conditional protection without forcing immediate liquidation into an empty order book. For example, you can utilize a protective put.
Okay, let's make sure that's clear. A protective put is essentially an insurance policy, right? You pay a premium for a contract that gives you the right to sell your shares at a specific price, no matter how far the market drops.
Correct. If the stock crashes, the put gains value, perfectly offsetting your losses on the shares.
It caps your downside risk.
But unlike a stop loss, it doesn't force you to actually liquidate your shares during a temporary volatility spike. You can just hold the put and let the market stabilize.
Okay, options certainly provide a more sophisticated risk profile, but they introduce premium costs. I mean, buying puts constantly creates a massive drag on your long-term performance. It's expensive insurance.
True, protection has a cost, but you can mitigate that by building a collar.
Break down the mechanics of a collar for me.
Think of a collar like self-funded insurance. You buy your 100 shares of stock. You want to protect them, so you buy that protective put below the current price.
Right.
To pay for the cost of that put, you simultaneously sell a covered call above the current market price. By selling the call, you collect a premium. You use that cash to pay for the put.
The trade-off being you cap your upside. If the stock skyrockets past your call strike, you have to sell it at that price.
Exactly. You trade away extreme upside for guaranteed self-funded downside protection. These strategies provide defined structural defense.
I see that.
But look at the professional trading philosophy. Relying on retail technology like a hard stop to execute your exit proves a lack of discipline. Professionals keep their intent hidden from the order book.
Hidden intent, sure.
By utilizing mental stops enforced by rigorous sizing, you retain the optionality to manually close the trade when market conditions stabilize, rather than being algorithmically forced out at the absolute worst possible price.
Okay, that is a heavily idealized view of human behavior, and I directly challenge the reality of human psychology in that scenario.
Idealized?
How? If you're listening to this and thinking, oh, I have discipline, I'll just use a mental stop, you desperately need to understand the neuroscience of trading. Strict position sizing is mathematically sound on paper, but enforcing it with a mental stop is a critical behavioral flaw.
I disagree. Human discipline can be trained. It's the most vital skill a participant can develop.
It can be trained, yes, but cognitive biases are incredibly powerful when real capital is evaporating. Let's walk through the exact biological process. You buy an asset at $100. You set a mental parameter to exit if it drops to 90.
Okay.
The market drops, and the price hits your exact mental trigger, $90 on the screen. What actually happens in that fraction of a second?
The disciplined trader executes the sell order.
But the vast majority of human beings lack machine-like discipline because cortisol floods the brain.
The stress hormone.
Yes. Your brain immediately begins bargaining to protect your ego from realizing a failure. You see the price bounce to $90.10. You tell yourself it's just a liquidity grab by the market makers. You hesitate.
People do freeze up, sure.
That hesitation turns a small, planned exit into a slightly larger loss as the price drops to 88. Then the price drops to 85, and you widen your mental parameter. You promise yourself you'll sell as soon as it bounces back to 90.
See, that is a failure of the individual, not a failure of the method.
I argue it is a predictable, universal failure of human nature. By the time the emotional pain becomes unbearable and the trader finally clicks the sell button manually, the stock is at 70. They have taken a loss drastically greater than their original mathematical parameter.
It happens a lot.
Here is the crux of the issue. A physical stop fires when the human is at their weakest emotionally. A mental stop requires the human to be at their absolute strongest, exactly when their brain is flooded with panic.
I see your point.
Making the mechanical stop loss mandatory is the lesser of two evils. It enforces the mathematical limit when the human inevitably fails to do so.
Okay, I understand the behavioral argument. The psychology of loss is powerful. But you are trying to solve a psychological flaw by utilizing a structural tool that actively works against your long-term returns.
Against long-term returns?
Yes. Connect the dots to the research from the CFA Institute. They examine this exact dynamic regarding mental comfort versus actual portfolio growth. They found that tight physical stops optimize for temporary psychological comfort over actual economic outcomes.
Well, yeah, because the trader feels safe. They can sleep at night knowing their downside is definitively capped on that specific trade.
Right. The isolated trade feels safe, and regret is minimized in the short term. But markets reward sequences of decisions made under uncertainty over a long timeline. Profitable opportunities rarely develop smoothly.
They definitely do not.
The early phases of a trend are highly volatile. They are marked by sharp reversals, false starts, and wild swings. Narrow stop losses systematically remove investors during precisely this stage. You don't get stopped out because your underlying thesis about the company is wrong. You get stopped out because short-term price fluctuations exceed an arbitrarily tight threshold. It truncates your exposure too aggressively.
It shakes you out before the thesis can play out.
Exactly. And capital growth is multiplicative. If you constantly cut your exposure during normal volatility, you destroy the mathematical compounding required for robust portfolio growth. You lock in small losses over and over, bleeding your account dry by 1,000 cuts, all while seeking the comfort of a mechanical safety net.
Which returns us right back to the absolute necessity of widening the stop using dynamic metrics like ATR. You accommodate the early volatility rather than relying on tight, static chart lines that guarantee you get shaken out.
Even widened, the physical order remains a visible target on an adversarial order book. You are literally broadcasting your absolute breaking point to counterparties whose explicit goal is to acquire your assets at a discount. In any adversarial environment, hiding your pain threshold is a tactical necessity.
Okay, I think it's time to summarize our positions in light of the mechanics we've explored today.
Good idea.
I reiterate that physical stops, specifically when calculated intelligently, using dynamic volatility metrics like the average true range, rather than static chart lines or predictable round numbers, serve as an indispensable circuit breaker. They protect against both localized technological failures and the undeniable fragility of human emotion during periods of acute financial stress. You simply cannot trust a panicked human brain to execute a mathematical exit.
And I summarize that true risk management requires keeping your intentions completely hidden from the market, relying on robust mathematical position sizing so that no single trade can ruin you, utilizing alternative hedging like options callers to self-fund your downside protection, and resisting automated tools that routinely truncate capital growth in choppy markets, ultimately offers a structurally superior defense.
Now, I will acknowledge that despite our different mechanical approaches, we completely agree on one undeniable reality presented in the material today.
Oh, definitely. Simplistic placement of protective orders at obvious technical levels or round numbers completely guarantees exploitation by larger market participants.
Absolutely.
If you place your stop exactly where the rest of the crowd places theirs, you are ensuring your own liquidity will be harvested. You are serving yourself up on a silver platter.
This leaves us with a compelling tension between market efficiency and individual protection. Listeners must consider whether they prefer to trust an automated order placed on an adversarial order book or their own mathematical preparation and psychological discipline.
There's plenty more to explore in the material regarding advanced order types too. Things like stop limit orders, which add a specific price ceiling to the execution to prevent that severe boulder down the stairs slippage we saw during the flash crash.
Right. Because choosing how to fail is just as critical as choosing how to succeed.
Extremely well said.
Returning to the concept we discussed at the beginning, you build a safety mechanism hoping it catches your fall. But if you leave the key under the welcome mat, you cannot be surprised when the mechanism is used against you.
Understanding the mechanics of the market allows you to move the key.
Exactly. Thank you for listening.